here's a question. How many times have you decided to enter the market and the trade goes your way right out of the bat? It's exciting to the point that you start calculating your profit. And because you did your homework, you set a stop loss at the previous swing high here. Just then, the market starts to move against you. Before you know it, your stop loss is hit. And now you get back to your drawing board. That's exactly what I did in a similar situation before I was introduced to the Elliott wave principle in a similar setup. Well, this is embarrassing, but here's what young me did when I faced this setup. I thought that since a higher high is registered, then it's possible that the downtrend has ended, and I could be profitable if I got in early. Here's how the market unfolded, and at the time, I thought that the market is definitely out to get me. But is that the truth, or is it just how we console ourselves following a loss? By the way, this chart is not just an example, it's a chart of price action this October for the US 30 years T-bonds. My name is Nady Laymoud, and welcome to ETV here at Elliott Wave International. Let me show you how we navigated that trap a couple of weeks ago and how you can avoid being caught in it. Now, you know why I studied this pattern, because I was literally burned by it before. This pattern is called the expanded flat correction, aka the pole trap. It consists of 3 waves A, B, and C, with 3 waves for wave A, 3 waves for wave B, and 5 waves for wave C. The important point here is that wave B always registers a lower low below the origin of wave A here, and it unfolds in characteristic 3 waves, not the typical 5 wave we would expect if the larger degree downtrend has resumed. Now, let's go back to the intraday chart of US 30-year T-bond and see if we can spot that pattern in action. At the low of wave 3 here, we are looking for a corrective bounce prior to registering lower lows. However, the 3 wave bounce we see here was shorter than anticipated, both price and time-wise. While that is not an ideal situation, it remains within the realm of possibility that the correction was brief and that the larger degree downtrend has resumed. At this stage, the possibility of an expanded flat was brewing and time was needed before jumping to conclusions. Typically, wave B within an expanded flat retraces somewhere between 1.23 and 1.382 times the length of its first wave here. Right after that zone was hit, the market started to show signs of strength, leaving behind a 3-legged pullback, which indicated that the probabilities of an expanded flat correction are high. Here's the chart that we published then. Based on that expanded flat scenario, we calculated resistance that may coincide with the end of the final leg of that counter-trend move. We identified a Fibonacci cluster where wave C would equal 1.618 times the length of wave A, which is a common relationship, and then where the larger degree correction, wave 4 here, would have traveled 0.382 times the length of wave 3. A couple of days goes by, and here's how prices unfold. The cited Fibonacci cluster was met, and soon after, here's what transpired. My final 2 cents here are that when inspecting higher or lower extremes, always try to identify the simple 5-wave pattern to be sure that you will not fall for that trap. That's all for me today. Happy trading.